Listen carefully. I want you to set aside the daily price charts, the endless financial commentary, and the constant stream of economic headlines competing for your attention. What I am about to discuss is not another ordinary market forecast. I am not talking about a short-term rally. I am not talking about a temporary surge driven by speculation, social media enthusiasm, or a sudden burst of investor excitement. I am talking about something far larger. I am talking about a structural shift that develops over years, sometimes decades, before the majority finally recognizes its significance. Most people are completely blind to what is forming beneath the surface of the financial system right now. They are focused on interest rate meetings, they are debating inflation reports, they are reacting to employment data and quarterly earnings announcements, they are trying to predict what will happen next week, next month, or even next quarter. But history has never been shaped by short-term forecasts. The biggest financial transitions emerge when long-term forces begin colliding with each other. They emerge when debt reaches levels that can no longer be ignored. They emerge when confidence starts shifting in ways that are difficult to see until the consequences become obvious. You need to understand what is happening because if current conditions continue developing in the direction they appear to be moving, silver may not simply experience another ordinary bull market. It may undergo a historic repricing event that forces investors to rethink its role within the global financial system. When Ray Dalio studies economic history, he does not focus on individual market cycles. He examines entire monetary eras. He studies debt accumulation. He studies currency systems. He studies the rise and decline of financial powers. Most importantly, he studies what happens when long-term obligations become so large that maintaining the existing system requires increasingly aggressive intervention. Those patterns are not theoretical. They have appeared repeatedly throughout history, and many of the same warning signs are becoming visible once again. Across the world, governments continue expanding their debt burdens. Deficits remain elevated. Borrowing requirements continue increasing. Interest costs consume larger portions of public budgets with every passing year. Despite these realities, most investors continue behaving as though the financial system can operate indefinitely without consequence. That assumption deserves serious scrutiny. Debt is not merely an accounting figure. Debt represents claims on future production, future income, and future economic output. When debt grows at a reasonable pace, the system remains stable. But when obligations expand faster than the productive capacity needed to support them, pressure begins accumulating beneath the surface. At first, the pressure is manageable. Then it becomes noticeable. Eventually, it becomes impossible to ignore. The real issue is not whether these pressures exist. The evidence is already visible. The real issue is how policymakers respond once those pressures intensify. History provides a remarkably consistent answer. Governments facing excessive debt rarely choose austerity voluntarily. They rarely choose contraction. They rarely allow widespread financial pain if alternatives remain available. Instead, they seek ways to support growth, stabilize markets, and maintain confidence through monetary and fiscal intervention. That response may provide temporary relief, but it also creates consequences. Every expansion of liquidity influences purchasing power. Every increase in debt alters the relationship between currency and value. Every effort to postpone adjustment can increase the scale of adjustment later. This is not speculation. This is the recurring pattern that appears throughout monetary history. Most people fail to recognize this process while it unfolds. They see stock markets rising and assume prosperity is increasing. They see asset prices climbing and assume wealth is expanding. But real wealth is not determined by numbers on a screen. Real wealth is determined by purchasing power. It is determined by what your savings can actually buy. It is determined by whether your accumulated capital retains its ability to preserve value over time. That distinction becomes critically important during major monetary transitions because these transitions never announce themselves clearly in advance. They develop gradually. They hide beneath periods of apparent stability. Then one day, investors realize that conditions have changed far more than they previously understood. This is where silver enters the conversation. Many people still view silver through an outdated lens. They see it as a commodity. They see it as a speculative asset. They see it as an occasional trading vehicle that rises and falls with investor sentiment. But that perspective ignores silver's unique position within the modern economy. Silver occupies a rare intersection between monetary relevance and industrial necessity. Few assets possess both characteristics simultaneously. Fewer still possess them at a time when both forces are strengthening together. On the monetary side, silver has maintained value across centuries of economic change. Governments have changed, currencies have disappeared, empires have risen and fallen, financial systems have been created and replaced. Yet silver has remained recognized as a scarce tangible asset capable of preserving value during periods of uncertainty. Those characteristics become increasingly important when confidence in long-term purchasing power begins facing pressure. At the same time, silver's industrial importance continues expanding. Modern technology depends on conductivity. Advanced electronics depend on conductivity. Energy infrastructure depends on conductivity. The transition toward greater electrification depends on conductivity. Silver remains one of the most effective materials available for many of these applications. This is not a temporary trend. It is a structural transformation occurring across the global economy. Every new data center requires infrastructure. Every expansion of advanced manufacturing increases material demand. Every investment in energy systems increases demand for components that rely upon silver's unique properties. As these trends accelerate, silver's strategic importance continues growing. Now consider what happens when monetary demand and industrial demand begin strengthening simultaneously. Investors seek silver because they want protection from financial instability. Manufacturers seek silver because their operations require it. Two separate demand forces begin competing for the same finite supply. That dynamic creates conditions capable of producing extraordinary market outcomes. Most investors will not recognize the significance immediately. They never do. The majority waits for confirmation. They wait for media attention. They wait for experts to reach consensus. They wait for prices to move substantially higher before accepting that a structural change is occurring. But by the time that confirmation arrives, much of the repricing process may already be underway. That is why understanding the underlying structure matters more than reacting to headlines. Headlines tell you what happened yesterday. Structural analysis helps reveal what may be developing tomorrow. And right now, the structure deserves very serious attention. Now, I want you to look beyond silver itself and focus on the environment that may be creating the foundation for a much larger move. Silver does not exist in isolation. No major asset does. Every significant repricing event throughout history has been connected to larger shifts occurring throughout the financial system. The asset receives attention later. The underlying conditions come first. Most people still believe central banks remain fully in control. They assume policymakers can solve any problem through interest rate adjustments, liquidity programs, stimulus measures, or emergency interventions. For decades, that belief appeared reasonable. Each crisis seemed to be met with another policy response. Each downturn was followed by additional support. Each disruption was eventually stabilized. But there is a critical difference between managing a system with moderate debt and managing a system carrying historically elevated obligations. You need to understand why this matters. When debt levels remain manageable, policymakers possess flexibility. They can raise rates when inflation becomes excessive. They can lower rates when growth slows. They can stimulate activity when confidence weakens. The economic machine responds relatively normally. However, once debt reaches extraordinary levels, flexibility begins shrinking. Every policy decision creates consequences elsewhere. Raise rates aggressively and debt servicing costs increase dramatically. Lower rates too quickly and inflationary pressures intensify. Support markets continuously and purchasing power faces pressure. Withdraw support and financial instability begins emerging. This is the dilemma confronting many major economies today. Governments require growth. Consumers depend on credit. Corporations depend on refinancing. Financial markets depend on liquidity. The entire structure increasingly relies upon conditions that are becoming more difficult to maintain over long periods of time. History has shown repeatedly that systems built upon expanding debt eventually require additional support simply to preserve stability. Each cycle demands larger interventions. Each disruption requires more accommodation. Each recovery becomes increasingly dependent on favorable monetary conditions. Eventually, the system reaches a stage where policymakers spend more time reacting than leading. That is when investor psychology begins changing. For years, many investors focused almost exclusively on growth. The strategy appeared logical. Asset prices continued rising. Liquidity remained abundant. Risk seemed manageable. Financial markets rewarded those willing to embrace leverage and speculation. But market environments do not remain constant forever. When conditions begin shifting, investor priorities change as well. Preservation becomes more important. Scarcity becomes more valuable. Stability becomes more attractive than excessive risk. Capital starts searching for assets capable of retaining value even if the broader financial environment becomes increasingly uncertain. These transitions rarely occur overnight. Initially, only a small minority notices the change. Then institutional investors begin paying attention. Gradually, capital allocation strategies start evolving. Eventually, the broader public recognizes what has already been happening beneath the surface. By that stage, significant repricing often has already occurred. This is why understanding structure matters more than predicting individual headlines. Right now, several powerful forces appear to be converging simultaneously. Debt continues expanding faster than many economies can comfortably sustain. Fiscal deficits remain elevated. Geopolitical tensions continue increasing uncertainty across global markets. Central banks face growing limitations. Concerns regarding long-term purchasing power continue attracting attention among serious investors. These forces do not operate independently. They reinforce each other. Together, they create an environment where confidence becomes increasingly important. Modern financial systems ultimately depend upon confidence. Confidence in currencies, confidence in government obligations, confidence in monetary management. As long as confidence remains strong, imbalances can persist far longer than expected. But once confidence begins weakening, behavior changes quickly. Investors become more defensive, portfolio allocations change. Risk assessments evolve. Demand for tangible assets increases. The search for wealth preservation accelerates. This is one reason silver deserves serious consideration, not because of temporary excitement, not because of social media enthusiasm, not because of speculative narratives, but because silver sits directly at the intersection of multiple structural trends that appear to be strengthening simultaneously. Consider the industrial side alone. Nations continue investing heavily in infrastructure. Energy systems continue evolving. Advanced manufacturing continues expanding. Artificial intelligence requires massive technological support networks. Data centers continue multiplying. Electrification remains a strategic objective across much of the world. Every one of these developments increases demand for materials capable of supporting modern technology. Silver occupies a uniquely important position within that framework. Its conductivity remains extraordinarily valuable. Its applications continue expanding. Its strategic relevance continues increasing. At the same time, supply dynamics remain more constrained than many investors realize. This is one of the most misunderstood aspects of the silver market. Many people assume higher prices automatically create unlimited new production. Reality is far more complicated. A significant portion of global silver production originates as a byproduct of mining operations focused primarily on other metals. This means silver supply is often influenced by factors unrelated to silver demand itself. Production cannot always expand rapidly simply because investors suddenly want more silver. That creates an important constraint. When demand accelerates faster than supply, markets adjust through price. And price adjustments can become surprisingly powerful when the available market remains relatively small. Silver remains tiny compared with global bond markets. It remains tiny compared with global equity markets. It remains tiny compared with global currency markets. The amount of capital required to create meaningful pressure within the silver market is far smaller than most investors appreciate. That reality becomes important during periods of shifting capital flows. If even a modest percentage of global investment capital begins seeking exposure to scarce tangible assets, the effect on silver can become substantial, not because the capital itself is unprecedented, but because the destination market is comparatively small. This is why historical silver moves have frequently surprised investors. People assume repricing must occur gradually. Then conditions change, demand increases, supply struggles to respond, investor awareness expands, and suddenly the market begins moving much faster than expected. The catalyst is rarely a single event. The catalyst is usually the recognition that underlying conditions have shifted. That recognition may already be beginning. The real question is not whether volatility will occur. Volatility is inevitable in every market. The real question is whether the forces supporting silver appear stronger today than they were several years ago. When I examine debt burdens, fiscal expansion, monetary constraints, industrial demand growth, supply limitations, and purchasing power concerns, I do not see those forces weakening. I see them intensifying. That observation does not guarantee immediate outcomes. Markets rarely move according to simple schedules. But it does suggest that the foundation supporting silver may be significantly stronger than many investors currently understand. And if that foundation continues strengthening while awareness continues expanding, the eventual repricing could be far larger than the majority currently expects. I want you to think carefully about what happens when an ignored asset suddenly becomes impossible to ignore. That moment has defined some of the most important market transitions in financial history. For years, the majority pays little attention. Analysts focus elsewhere. Capital flows toward more popular opportunities. Financial media concentrates on whatever sector currently dominates headlines. The asset remains overlooked, misunderstood, and frequently dismissed. Then conditions begin changing. At first, almost nobody notices. A small group studies the underlying trends. A handful of institutional investors begin adjusting their positions. Long-term capital starts moving quietly. The broader market remains focused on other stories. Eventually, awareness expands. More investors begin recognizing the shift. More capital begins entering. The narrative starts changing. And by the time the public fully understands what is happening, the repricing process is often already well underway. This pattern has repeated throughout history. Early recognition, gradual accumulation, expanding awareness, accelerating participation, widespread acceptance. The sequence remains remarkably consistent. Most people enter near the end because they require overwhelming evidence before adjusting their assumptions. They need visible proof. They need consensus. They need confirmation from experts, institutions, and headlines. Unfortunately, visible proof usually arrives after much of the opportunity has already developed. This is why long-term cycles matter. Cycles reveal pressure before consequences become obvious. And today, multiple long-term cycles appear to be converging at the same time. Debt cycles, monetary cycles, industrial transformation cycles, geopolitical cycles, confidence cycles. Each one is significant independently. Together, they become considerably more powerful. When Ray Dalio discusses major historical transitions, one principle appears repeatedly throughout his work. Transformational events rarely occur because of a single catalyst. They emerge because multiple forces align over extended periods. Pressure accumulates, imbalances expand, confidence shifts, capital responds, markets adjust. The majority notices only after the process has already begun. That framework is important because many investors continue searching for one dramatic event that explains everything. One policy decision, one economic crisis, one government announcement, one market shock, one headline. But structural transitions rarely unfold that neatly. Sometimes the catalyst is simply accumulated pressure reaching a level where existing assumptions can no longer be maintained. The system changes gradually until eventually it changes suddenly. Investor behavior adapts, capital flows evolve, assets previously ignored become strategically important. Silver may be approaching such a phase, not because speculation guarantees it, not because extraordinary forecasts automatically become reality, but because the environment surrounding silver increasingly supports both sides of its identity. Its industrial role continues strengthening, its monetary relevance continues growing. That combination deserves attention. Industrial demand creates support. Monetary demand creates acceleration. Together, they create conditions capable of producing unusually powerful repricing events. Now, consider what may happen if purchasing power concerns continue increasing over the coming years. Consider what may happen if debt burdens continue expanding. Consider what may happen if governments remain dependent upon fiscal stimulus and ongoing borrowing. Consider what may happen if inflation remains more persistent than many policymakers expect. Under such conditions, investor priorities may shift dramatically, preservation becomes increasingly important, scarcity becomes increasingly valuable, tangible assets become increasingly attractive. History has documented this behavior repeatedly. Every generation believes its circumstances are unique. Every generation believes old patterns no longer apply. Every generation eventually discovers that human psychology changes far less than expected. People respond to incentives. People respond to confidence. People respond to perceived risk. When trust weakens, behavior changes. When uncertainty rises, investors seek protection. When purchasing power becomes a concern, attention shifts toward assets capable of preserving value. This is not a modern phenomenon. It is a recurring feature of financial history. Technology evolves, markets evolve, financial products evolve. Human behavior remains remarkably consistent. That is why monetary history matters. It provides perspective. It reminds us that debt accumulation has limits. It reminds us that financial systems experience transition. It reminds us that purchasing power erosion produces consequences. And it reminds us that scarce assets often regain strategic importance during periods of uncertainty. The real question is not whether another major transition is possible. The real question is whether the evidence supporting such a transition continues becoming stronger. From my perspective, several indicators deserve serious attention. Debt remains historically elevated. Deficits remain substantial. Monetary flexibility remains constrained. Industrial demand trends remain favorable. Supply limitations remain relevant. Investor awareness continues expanding. None of these factors guarantees a specific outcome. Markets do not operate according to certainty. They operate according to probabilities. But when multiple structural forces begin pointing in the same direction, probabilities start changing. That is where serious investors focus their attention. Not on daily volatility, not on temporary headlines, not on emotional reactions. They focus on long-term positioning. They focus on structural trends. They focus on the forces that shape entire market cycles rather than individual trading sessions. Because if this historic shift continues developing, silver may eventually be viewed through a completely different lens than it is today. Investors may stop seeing it as merely another commodity. They may stop treating it as a secondary asset. They may begin recognizing it as a strategic store of value operating within a changing monetary environment, while simultaneously supporting critical industrial demand. And when perception changes, markets can reprice far faster than expected. That is why this moment deserves attention, not panic, not blind speculation. Attention, serious analysis, objective observation, a willingness to examine larger forces instead of becoming distracted by short-term noise. Because the greatest opportunities often emerge while the majority remains focused elsewhere. And the biggest mistakes frequently occur when investors assume tomorrow will look exactly like yesterday. History rarely rewards that assumption. The financial landscape is evolving, monetary conditions are evolving, capital flows are evolving, investor priorities are evolving. The only remaining question is whether market participants recognize those changes early enough to position themselves intelligently. Most will wait, most will seek confirmation, most will require overwhelming evidence before changing their views. That has always been true, but investors who understand debt cycles, monetary history, purchasing power, and capital allocation often recognize important transitions before consensus forms. That is why the silver story matters. It is not simply about price targets. It is not simply about market forecasts. It is about what changing conditions may be signaling. It is about what growing demand may be revealing. It is about what shifting capital flows may be indicating regarding the future direction of the global financial system. And if the current trajectory continues, this move may ultimately be remembered not as an ordinary commodity rally, but as part of a much larger monetary repricing that reshaped how investors think about scarcity, purchasing power, and wealth preservation.